Good afternoon and welcome in. I am so excited to kick off the very first State of the Market for Launch Commercial Real Estate Network in 2026. Now, if you haven't joined us for one of these before, this is a call where we are going to give you a pretty thorough rundown of what happened in the previous quarter in the market. And based on that activity and what we're seeing in the full scope of things that impact commercial real estate today, what do we think happens next? Now, anybody's crystal ball is only as good as the data they're reviewing, the information that they're seeking, where they are actually reading and learning about the market that we're in. So a really important opportunity that Launch Commercial Real Estate Network has is we are brokerage agnostic. We are not married to any singular real estate firm or brand, which gives us the ability to read everybody's reports and share really transparently what is the unified messaging that we're seeing, where are the gaps in that messaging, and ultimately, what inside that messaging is most important for a broker like you to take back into their business to impact the clients that you serve. Today, we're going to go through a full presentation that not only touches on all of the product types inside commercial real estate, but that ultimately really determine with extreme clarity what is data focused in the conversation and what is going to be something that is truly speculative, purely hypothetical. If you've ever coached or trained with me, there are times I look up and I go, we're just hallucinating this outcome, because if it's not what actually data tells us did or could happen, it's just someone's inside narrative escaping them and showing up in our reality. So let's dive in. Again, this call today is hosted by Launch Commercial Real Estate Network. We are a collection of companies that look to solve anything on the back end of a commercial real estate agent's business. So if it's marketing, it's building a database and researching that database. It's analytics inside your business, doing client-facing materials, helping you prospect better each day. Even going into transaction coordination, transaction management, and listing support services. If it's not on the part of your business where you're client-facing and winning more business, Launch is not going to touch it, because our goal is to make you the most productive agent possible. If you want to book a demo for a meeting today with our team members who can help you kind of look at where you're at inside your business and where you want to be, and then diagnose what would be the best solution possible, or what solutions are there that we don't have, grab that QR code today and go ahead and scan that and get yourself set up for a needs analysis. And in that demo, we'll show you any of the products you're most interested in, and also maybe help you unpack what the real problem in your business is. If you are in this and you go, man, I want to be involved in more training, I want to have more tools and resources available at my fingertip. Another thing to consider would be Nucleus Commercial, the Nucleus Plus community. Nucleus is sponsoring today's call, and Nucleus Plus is an exclusive membership community available for less than $30 a month, where you will find other agents like you that are in growth mindset and be able to communicate with them in forums, be able to have an active deal share, 4 unique trainings every single month, a library of templates and documents that you can use in your commercial real estate business. Huge disclaimer on those, though, you need to check them with your broker of record and with the legalities of your state and where you practice real estate. This community is young and new and exciting, and I'm very proud of it, alongside my partner Bruce, because I really look up and ask, what's the missing piece in a lot of the businesses agents have? And more times than not, it's community. It's someone sitting in a cube next to them or in an office next to them that they can go, hey, what do you think about? And while this may not be in a physical, tangible location, this is where we give you the ability to sit side by side and in hand nationally with commercial real estate brokers just like you that are building a true, proper commercial real estate business. All right, well, let's dive in to our discussion together today, right? I want to give you something more useful than just optimism, or more disciplined than we might see headlines be. I want to give you a real market read, and not the version that sounds good in a LinkedIn post, not the kind that you might put in a marketing proponent, not the version that reduces a 20 trillion plus commercial property landscape to one lazy sentence, and not the version that treats every city, every product type, and every capital stack like they are moving in lockstep. Because here's the truth, they're just not. They're not moving in lockstep. If I had to summarize the last 12 months in one sentence, again, I don't love the one sentence parameters, but that's where we kick things off, right? I would say this: 2025 was a year commercial real estate searched for conviction. And I think that 2026 is the year it will begin to reward our precision, our decisiveness. And that is the shift, right? Last year felt choppy in most markets and deals took longer or fell apart altogether. Buyers wanted better basis, sellers were slow to reprice or course correct their pricing. Lenders were open but very cautious. And tenants wanted more flexibility while landlords wanted rent in integrity and they wanted to feel their values increase, right? Investors, on the whole, just wanted clarity on rates, clarity on cap rates, clarity on rent durability. In other words, the market was not frozen, but it sure as hell was guarded. And now, coming into 2026, the tone has changed a little bit. We'll go through some things today that help you have a different look at it, right? If 2025 was really searching for that conviction, 2026 is going to reward precision. Well, let's take a look at what that might look like. See, CBRE expects the United States commercial real estate investment volume to rise by 16% this year to about 805.5 billion. That's a big number. Cushman Wakefield says capital is flowing more forcefully into this property sector with a tone shifting from resilience to optimism. And at the same time, we see NAR in their March 2026 reporting, they say that economic momentum softened in February, but long-term yields remain above 4% and financial conditions are still relatively tight. And that is exactly why this market matters so much right now. We have improving motion without universal ease. That creates opportunity for the person who's prepared. And if you're not, that's going to ultimately make confusion really, really accessible. And so the real question is not whether the market is back. I want you to just kind of strip that one away. The real question is back for whom, back where, and back in what form? This is an important perspective on how we look at it because it's different in every area of our businesses. Now, before we go sector by sector, let me give you kind of the national thesis, if you will, in plain English. In the national story, right now, all of these reports, I've looked across 12 different reporting instances. In every single one, it's not broad-based exuberance. It is very selective in how they define recovery. In a market where capital conditions are better than a year ago, but not loose. It's a market where some property types are clearly strengthening while others are still working through structural impairment or supply overhang. It is a market where the quality is going to matter more and location is going to matter more and operating discipline matters more, and the ability to structure a deal, your work, darling, that matters more too. So we look back, the same three institutions, right? Cushman and Wakefield projects in 2026 GDP growth in the 1.5 to 2% range, supported by AI investment and steady consumer spending. We never know how to stop spending when the market tightens, right? CBRE's outlook, though, is built around roughly 2% GDP. They say that momentum softened in February, 2% GDP, and the inflation that they see is near the Fed's target with slightly softer labor markets. Now, NAR, their March update, it really stressed that the momentum softened in February and growth slowed heading into the end of 2025. So this isn't a booming economy, right? There's nothing about this that tells a fairy tale story. It is stabilization plus selective. Stabilization plus selective. And that's what we're seeing across the board. What it brings into light in my mind is informed confidence. Why? Because of selective economy, Commercial real estate does not reward broad confidence. It's going to reward informed confidence. And this is why I would describe 2026 as an investor's market. We're in one for sure, I believe. And it's an easy market where people can get paid for access to it. In a selective market, it's more than just access. It really is about our judgment. And judgment is what this hour is about. Some key points that you're going to hear me revisit again and again and again as we talk through the different product types that we're looking through. Capital is improving. Supply is normalizing in some sectors, not all. Stress still exists, especially around debt and office. I know office, poor darling child, we keep beating it up. And the best opportunities are going to sit where friction is highest, but fundamentals are not broken. Now, when I think about capital is improving, these two specific headlines I wanted to bring out because in one specific conference, we saw people get on stage and talk about how the total commercial mortgage or originations are going to increase by 27% in 2026. That's 805 billion, by the way. And at the same time, we have another speaker on stage. This is the MBA CRE convention, CREFE. And in the same stage, we see another speaker get up and talk about 17% of commercial and multifamily mortgage balances are due in 2026. Both of these could feel like a giant warning, a huge flag on the field, but they're actually both opportunities if our businesses are ready. And so we get into kind of the economic backdrop that's sitting inside all of this. And the backdrop is important for us to pay attention to because every property decision eventually runs through the cost of money and the confidence of the user. The economy entering 2026, this first quarter that we felt, is steady, but it's not explosive. Cushman even looks up and sees GDP in that 1.5 to 2.0 range. CBRE is around 2%. That's not massive growth. That's not massive optimistics or hope for like this giant spike. That's a very gentle step up into normalization or stabilization. When we think about the opportunity of like what that looks like, I think about this chart that CBRE put in their 2026 economic outlook. Now you can find the full report if you just Google CBRE 2026 economic outlook. I think it's one of the better outlooks that gets published they're pretty good about putting one out every single quarter, but I always look forward to the one that they do right out the gate at the beginning of the year, because this is one where they kind of like show what they're betting on. And a force like theirs in an industry like ours, that's worth listening to, right? This chart is showing what a bunch of smart grownups think might happen over time, right? They're looking at the treasury, they're thinking about how that might play. And we can take it one step further into this chart. And I say grownups because these are people that aren't looking at cap rates, they're not looking at speculative behavior that's really aggressive. They're just getting in and asking what might happen to the 10-year treasury yield, which is very important to interest rates. Think of it like this. The dark line through the middle is the best guess average of what people think will happen. The green bars, they're showing us the full range of guesses. It's like who hedged their bets where, right? And from the lower guesses to the higher guesses is what we're witnessing. And the bottom line shows moving from late 2025 all the way through 2028. And so we're not seeing any like massive radical movement. What it's telling us is that most people think that interest rates are going to stay pretty close to 4% for a while. That's not a bad thing. You got to remember those 2s and those 3s we were seeing for a while, those were a band-aid on a bullet wound. The average guess goes a little down over time, but not by a huge amount. And the green bars get taller, which means people disagree more about what could happen later. The further we get out, the more speculation kicks in. This is not a political statement, but the belief of what this is going to do has some spanning views based on left, right, or center. Because administration, while it can impact it, it doesn't directly make the changes, but it does put in some decision making around how does this behave. And none of this is telling us that we're going to see interest rates score. None of it is telling us that we're going to see it go egregiously low. It's giving us a really simple way to think about this. People think the rate is going to stay kind of high compared to what we've recently witnessed, maybe go down a little bit, but nobody is totally sure what will happen farther in the future. Now, why does that matter? Because interest rates affect borrowing money, and that can help change the way home loans and business loans and car loans, and even more importantly, so commercial real estate loans do. So this chart is really saying money may stay expensive for a while. The big message is not rates are crashing. The message is people expect rates to stay fairly high with a little easing later and more uncertainty as time goes on. Now, NAR notes really are NAR is pointing. Let me rephrase that instead of NAR notes. NAR really thinks that we're going to see some slowing momentum and financial conditions that remain tight all the way through 2026. The Federal Reserve's January Beige Book said that commercial real estate markets are genuinely going to continue to improve, while the Chicago Fed District specifically noted modest increases in commercial real estate activity, slight vacancy declines, and strong competition for industrial zone land tied to data center demand. Now, this is a very important setup. We're not in a collapse environment. We're not in a runaway growth environment. We are in a market where growth is sufficient enough to support activity, but not sloppy underwriting. And so the first piece that I want to come to is the debt markets and lending conditions, because when we want to talk about what's going on, we first have to talk about the oxygen supply. And this is why I want to bring on our friend and colleague, Chris Wezel. He's with us inside the Launch Capital Markets team. Chris, welcome in, my friend.
Thank you so much. I'm thrilled to be here with you all today. Thank you. I appreciate it, Alicia.
Yeah, absolutely. You want to give just a brief introduction to who you are, where you are, and what you do?
Sure, absolutely. My name is Chris Wezel. I own a commercial loan brokerage with a partner, and we really do any type of commercial loan, any size, anywhere in the country. So theoretically, a one-stop shop for any needs that anyone has for commercial financing, whether that's with real estate or without real estate, whether it's owner occupied or investment, doesn't really make a difference.
And that's Chris, one of the things I love about you, and it's why Launch got in relationship with you, is I can send you a deal and faster than any commercial loan broker I've ever worked with. You turn back not just one option and not just like a cocktail napkin. You bring back like multitude of real options to consider and different scenarios to consider. In a market like we're in today, why would different scenarios be important?
Um, as far as reaching out for capital, you mean?
Yeah. I got a listing or I have a buyer and we're looking at a deal.
Yeah.
Why are multiple options or scenarios important?
Because number one, rates in the residential world, as many of you probably know, are all within an eighth or a quarter of a point of one another. And that's very different in the commercial world. We've seen, as a matter of fact, we just had another one. It was an owner-occupied deal, but we saw rates between 5.79 and 7.75 on the same deal, same borrower, same property, same
I mean,
everything.
that's tens of thousands, if not hundreds of thousands of dollars
Yep, that was
different.
on a $4.5 million loan, a warehouse for a large HVAC company that needed to that was expanding. So it's literally $10,000 a month more that you'd throw away in interest. That's why one of the biggest things even before we started was to build a very significant database, which is now at about 2,800 lenders. And I will say mostly regional banks, national banks, credit unions, more the institutional lenders. We don't do a ton with hard money.
Right.
Um, but when we're delivering quotes, it's not uncommon for us to get 30 or 40 quotes on a loan based on the platform that we developed, and it enables us to do that. So it is really important to shop rates in the commercial space. And, lenders like to have a very balanced portfolio. They don't want to have too much industrial, too much hotel, too much retail, too much multifamily. They like that portfolio balance because if they have too much, it's putting them at risk, right? So that's why I could bring the same loan for, let's say, an industrial building to one lender, and that lender can say, well, Chris, we can do this, but it's going to have to be at 8% because we already have a lot of industrial. I
Right.
bring it to a completely different lender, and they could say, "Oh my gosh, we have plenty of hotel, we have retail, we have this, we have that. We need industrial. We'll do
Yeah,
this."
they're geeked out on that right now, so they get more competitive.
Correct. And that's exactly why, we search so many lenders when we do this. And, speaking here too, I'm not an analyst, but I do see what lenders are looking for and what their buy boxes are and what general underwriting guidelines are looking like. So it gives me a good overview. As a matter of fact, some of my clients that are investors, they will take the quotes that I give them and determine whether or not it's a strong opportunity from them or not. Because let's face it, these banks have very, very professional underwriters that are
Right.
underwriting these deals. If a bank doesn't like it, you may want to rethink whether or not you like it or it's right for you if you're an investor building up your portfolio. That makes sense?
Yeah. Yeah, absolutely. That's okay. So, do you have slides to share today or no?
I do, if you'd like, or we can have a conversation. Either way, I have my slides up. I sent them to you guys in
I'll
the.
go ahead and pull them up. Let you share your slides, and I might jump in for some conversation along the way.
You bet. Hold on a minute. Let me get this to the right view. uh, can you see my screen or no?
Not yet.
Well, hold on. Let me share first. Here we go. Share. Now
Perfect. We're good to go.
can you see it now?
Yep.
All right, giddy up. Perfect. So what I could give you guys is kind of a market snapshot from more of a lender's perspective, because that's really what I see most of, right? If I send out a loan package to 50 or 60 lenders, I'm getting those responses, I'm getting those questions, and we kind of gather that information. We actually keep a lot of that information internally so we can help our clients or the brokers we work with determine what markets maybe they want to shift to a little bit or put a special focus on. So right now, and kind of what you mentioned, Alicia, the demand is remaining strong. Okay. As a matter of fact, from a lending perspective, over the last 3 months, I've seen 100% growth in loan requests over the same 3 months last year. 110% more loan requests than I saw last year. We didn't do anything to market anything different. We have our same partnerships with different real estate brokers around the country.
That's a significant difference, though.
Incredible difference. I mean, so much that we've had to actually add a couple of people to help us because we got to the point where we were sort of maxed out. So, but what we've seen from this is, at least based on the opportunities I'm getting, and I do like the fact that we handle everything because we do get a view of how everything is
The whole thing, yeah.
applied to lenders. So, industrial, medical, and certainly owner occupied. Banks are all over the owner occupied market. So, if there's ever an opportunity that comes across our desk and it is an owner occupied, a doctor wants to buy a new office building to have his practice in, or an HVAC company wants to buy a warehouse, doesn't make a difference. Banks are paying very, very close attention. As a matter of fact, it's the most competitive. When I get quotes from that, I will always get that little line underneath that says, "Hey, let me know what I have to do to secure this loan." That's how
Oh, love that.
it
The
is.
medical office is where they're jumping off at.
Any kind of owner occupied. It could be a roofing company that wants to buy a building. They just want that business cash flow
Right.
to support the debt as opposed to investment real estate. Not that investment can't get done. It obviously is getting done. Um, to your point as well, Alicia, large office is definitely struggling. There's a 17% vacancy rate. Lenders are extremely cautious about office. So that is one area that I don't know that I really see that changing anytime in the very near future. That I
Yeah.
think COVID drew everybody to work from home. A lot didn't go back. Now, small offices, well, owner occupied is definitely different, but small office can be a little unique. If you have, a small office building with 5 tenants as an investment property, and the leases are strong, and the sponsor is strong, not as difficult as an opportunity like I have one now here in Orlando that is 70. It's an office building with 70 offices in it, and it is about
Mm.
90% occupied, and the sponsors are strong, but lenders are still very cautious of that.
Yeah.
Um,
With good reason.
Oh, for sure, without a doubt. I agree with you. Medical office, definitely a strong demand. Lenders love it. If I bring them a doctor that's been in business 2 years or longer, they are thrilled. Even on an investment side, we just closed on a portfolio of 3 surgical centers in North Carolina, and I had lenders competing for that loan left and right. They all wanted that opportunity. Industrial, at least in this market. I don't, be honest, I don't do a lot of industrial outside of Florida, Texas, and the Carolinas. I just haven't had a lot of other opportunities. But for those markets, it's been extremely strong, and lenders do love industrial properties. There is still just such a high demand for them and not enough inventory. Um, Retail and mixed use, still a strong demand, but lenders are definitely, they're comfortable, but
Right.
they're a little cautious of them. The occupancy or the vacancy rate is pretty low, at least in many of the markets. So it's not as risky as some as office, let's say. But we are seeing them, comfortable with it, but still scrutinizing it quite a bit and really taking a good look at it. And then as
Interesting.
far as multifamily goes, right now it's about an 8.4% vacancy rate. Demand is still strong. Lenders will look at it, but again, very, very cautious. When it comes down to those, they're looking for two things. They're looking for experience of the sponsor and overall financial well-being of the sponsor, including liquidity. So, I'll get some of these value add opportunities that come across my plate. And if the sponsor's not strong enough financially, or they don't have a lot of experience, those are real hard deals to get done. If the debt is not being covered, if the debt service coverage ratio is too low, and it's
Right.
a weaker sponsor or a sponsor with not as much experience, it's going to be very, very difficult.
Mm. Right.
Um, okay.
I mean, I think about so much of this and it tethers back to the 10-year treasury, right? And so if I'm a newer agent or I'm just newer to tracking this, what am I looking for in that 10-year behavior to start to say caution is lifting a little bit?
I'm sorry, say the first part again.
If I'm watching the 10-year treasury,
Uh-huh.
what would I need to look for in that to determine that caution is reducing or
Oh,
fear of a certain type of debt is reducing?
um, I don't have a good answer for that. I don't know exactly. I just, we try to refine things down to what lenders are looking for, because quite frankly, that's how I make my money. I have to know
Right.
what they want so that I know when opportunities come in, I know how viable they are. I can't really give you an answer to that question. I'm sorry, Alicia.
No, that's okay. I think it's answering itself whether we intended it to or not. The relationship of how many different lenders you can go to and talk to makes that a fairly fluid solution.
Yeah, absolutely. If I'm trying with a new opportunity and I've exhausted 5 or 6 lenders that no, 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 it's pretty rare that the seventh or eighth or ninth or 10th one come in and say, yeah, this is something we can do. So
Right.
I'm always judging, the opportunities that come in. I'm kind of basing them on what the lender's appetites are and where I know
Right.
I'm going to have success and where I know I'm going to have challenges and in some cases how to overcome those challenges. I had a client it was an investment property, a multifamily property, and I said, "Hey," and he said he got, this opportunity from a friend of his that is in multifamily, that is an investor. And the client couldn't get it done on his own, but bringing in the investor that told him about it as an additional partner, we did get that deal done because the investor had strong liquidity and had a lot of experience in that market. So sometimes you have to think outside the box a little bit in order to get where you want to be.
I love that. I do think thinking outside the box is going to be what sets apart, like, for lack of a better term, like the boys or girls from the men and women, because it's going to be the relationships they have in their business that help them have access to the debt that can solve more deals.
Hmm.
Even in my coaching or our consultation side of things this last year, the agents that just got clobbered with deals closing or falling apart, I should say, before they got to closing, it was debt more than not that was the reason they couldn't close that deal.
Last year was a struggle. I'm not going to lie.
Yeah.
There were a lot of deals that we brought to the table. I mean, I probably touched 350 to 400 loans last year. And of that, I think we closed 78 or 80 loans altogether.
So it's not just their businesses. I mean, you're feeling that too. And I think that what we're seeing in global economics and localized economics is going to keep driving the narrative of where is confidence sitting.
Yeah. Yep, exactly. So
Awesome.
a little bit of what I'm seeing as far as typical loan terms, rates, that kind of thing. On investment properties, pretty much across the board, and I'm talking about a relatively strong sponsor with strong credit, some decent liquidity. But I'm seeing investment rates anywhere. Actually, we just got quoted one which was 5.9, which I was kind of excited about. That was on a retail center. A long-term lease. We just closed on a Pollo Tropical here in Orlando, and that was at a rate of 5.85 with a 25-year guaranteed lease. So it's going to vary quite a bit, but really anywhere between 6 and 6.75 is where I'm seeing on investment properties. On owner occupied, there are a lot of programs out there right now. The one I have below is a crazy program by one of the lenders that we work with. We put 5 loans in their hands over the last 3 days. And
That's great.
see those terms. This is just an example. This is their example of the terms that you could secure. But imagine a 5-year, 15 amortized loan, for 4.99%. I mean, I can't remember the last time we were under five in
It's
general.
been a while. Absolutely. I mean, all of these are sitting decently close to five. It's that
Correct.
longer term amortization that you're getting some benefit from. But I mean, these are all great loans.
Absolutely. And again, I know the banks want these. You know why they make money on the loans, but more importantly, they make money on the banking relationship. That's really what they want. They do the loan because they have to
Right.
get with that business so that they can get their banking relationship. And as a matter of fact, most lenders are requiring that at this point. So not all of them, not SBA in any way, but on conventional owner-occupied financing, if you want to take out a loan to buy a building to operate out of, the bank wants that banking relationship, and some banks will turn it down if you're not willing to give it to them. So
Yeah.
just something, that they need to know because again, I believe that's where the banks are making most of their money is,
100%. Yeah.
whether it's the merchant transactions, the accounts receivable and payable running through there, that's the relationship that they want.
Yeah.
Loan
Oh,
terms are between 5, 7, and 10 years. Amortized over 20 to 25 years. Depends on the year the building was built. There's a lot that goes into what they're willing to offer. And then prepayment penalties are still demanded for the most part. It's rare that I can negotiate those. Usually, if it's a 5, 4, 3, 2, 1, I can get it down to a 3, 2, 1. Um, in some cases, I can get it down to a 3, 2, 1. However, we can agree that if the borrower refinances with that same lender, they won't pay a penalty. So if the rates drop in 2 years and the borrower wants to refinance the loan, they can do that without paying any penalty at all, as long as it's with that same lender.
love that.
And
Yeah.
then you mentioned
Again, relationship is going to win you the result because the better relationship you decide you're willing to get into with that bank, the better the terms will offer.
100%. Yep.
Love that.
LTVs, so on owner occupied up to 90%. Actually, even on SBA loans, if it's an expansion, we can get as high as 100%. We just did 2 of those back right before the holidays where they were expansions. They already owned a building or were leasing a building, both of them, and wanted to buy a building. They'd been in business for a couple of years, and we were able to secure 100% financing on those as an expansion. That is going to be an SBA loan. If you're going with owner occupied conventional, you're looking at more of an 85% loan to value. Investment property is going to be 70 to 75% based on the type of property, based on the borrower, based
Right.
on the amount of income coming in from the property. The net income is how much is it supporting the debt. Multifamily, we're getting up to 80. Actually, the last one we did, we got up to an 80% loan to value. Very strong borrower and strong property. So that was a nice surprise because I had been seeing 75% for the longest time.
That
Um,
is a nice. Yeah.
Land is difficult unless, like you said before, Alicia, unless it's land that has immediate opportunity for development. And I'm
Yeah.
talking within the next 12 months. If somebody just wants to buy a piece of land to sit on it and hope the value is going to go up, max LTV is going to be 50%. And even that is challenging to find a lender that's willing to do that.
Well, I mean, I think it's important to define, development within 12 months. That doesn't mean that like you start breaking ground somewhere in the 12 months. A lot of times they want to see that like you're going to be down the thoroughfare, out of pre-development, out of your pre-planning, foundation ready to be poured. Like they want you as close to income as possible at the end of that 12 months.
Well, even to bid on it, for to get a lender to put in a quote on it, they want to see the architectural drawings. They don't, the ground could be raw, it could be rough land, but
You
they
don't even own it yet.
the
Yeah.
architectural drawings, the projections of the property. I mean, it's not as easy as, hey, let me buy this piece of land and wait and I'll develop it in 2 years from now. That's going to be really, really difficult to accomplish.
Yeah. Yeah,
Um,
absolutely.
Obviously, higher leverage available for SBA, whether it's a 7A or a 504 loan. Again, we're back to the 90%, sometimes 95%. We just did one with an owner held a 5% note. So the borrower came in with 5%, the owner held the 5%, and then the 90% was done through the SBA lending.
Love that.
The focus. Um, Value add opportunities, again, are really hard unless it's a strong financially and experienced sponsor or borrower. So, what the banks are still typically looking for, I can pull through a debt service coverage ratio of 1.2, where there are a handful of lenders that are a little bit more lenient. Most are looking for 1.25. That's what they want to see. So, for every dollar the borrower is borrowing, they want to see $1.25 in net income come in.
Yep.
Um,
Not gross income, net income. The
net
amount of agents I've had to clarify that with, like, doesn't matter what the gross is. If the expenses are a mess, you're out of line. Yeah.
exactly. Yeah, I've had that before. I had a client, they literally grossed $3.5 million and they showed $25,000 as net income for the business. And I'm like, how? Like, I don't even know what you can write off to get to that point.
Yeah.
That is just a ton. And that's challenging. I have to kind of educate borrowers a little bit, when they come and they want to buy a property and they say, "No, but I made 300,000 last year." And I said, "No, you didn't. According to the IRS, you made $25,000 last year. Now we maybe can get add backs in there to kind of bring that number up a little bit. But for the most part, that's what a bank is looking at.
Yeah.
So it makes it more challenging. Strong global cash flow and liquidity is I feel like liquidity is one of those things that's becoming a lot more prevalent, the requirement that lenders have. If you were buying a building for $1 million and you put down, let's say, I don't know, 250,000, and you only had $5,000 left in the bank, I'm not going to get that through. The
Right.
lenders want to see probably 6 months of post-closing liquidity, still in the bank after closing. So I think that's a good number to go for. Some may be a little bit more lenient. Some will even look at if it's a business, an owner-occupied opportunity, they'll look at their cash receivables, what's left out there. They'll look at inventory to determine, are they comfortable with where the buyer is or where the borrower is going to be after they close. Um, Non-recourse loans are still available on select stabilized assets. So we're not going to see that on a value add opportunity. We're more so going to see that on something that is stabilized. And we're definitely getting very quick approvals for experienced owners that have, full documentation. The numbers are strong. As a matter of fact, my average closing time frame now is 34 days. That's on average.
Wow.
Yeah, insane. Not I'm sorry. Let me pull SBA out of that.
Okay.
SBA
Yeah. I mean, that's a whole separate bag of worms. But I
also,
mean, anything under 45 or 60 days, that's exceptional.
yep, we've been
That's
getting
great.
approvals. There's a few lenders that we use that have a score only program for any loan under 1 million, and we get approvals on those in 24 to 48 hours. Like
I
I
love
submit
that.
the loan package, and within a day or two, I'm getting back to them with the approval. We're ordering the appraisal 3 weeks, a week to prepare the closing documents, and boom, we're closed. So super,
I
super.
love that. I mean, what I'm hearing in that is that it's again like we're stepping away from the hype and the excitement that value add buildings can create, right?
Yep.
And we're back to the fundamentals of you got to have a solid asset with yourself as a solid investor, and we can get you solid debt.
Yep. And I,
I
and
love
believe
that.
I get the value add opportunities. I think they're great. They just have to be for the right investor, the
Right.
investor that has experience and has some liquidity so that the first thing a bank says is, okay, you're going to buy this value add. It's not even hitting a 1.0 DSCR. So how is that? How are you going to pay the bill when the mortgage comes next month? It's going to be due next month. Where is that?
That's right. Out the gate. And you are maybe 3 or 4 months from even having the right tenant in the building, much less having the space ready for them.
Exactly. Exactly. Um,
Perfect. Well, Chris,
that's
I want to be respectful of your time and of our participants. We've got about 20 minutes left to get through all of our product types.
hmm.
We have a QR code that is available at the end of the deck as well. If you guys want to get in touch with Chris, he's also got his email address available to you guys. I think he's one of the best commercial lenders I've ever had the opportunity to meet or work with. Not only from how like diligent you are in the process and the relationships that you bring to the table, but you're always like educating the client as well. So if I have a client that comes to the table, I don't feel like they're gonna get bamboozled working through everything. If you guys have questions, if you want to drop them in the chat, we can get those in, and we're gonna dive into our product types really quick. Chris, as always, thank you, friend. All right, let's dive in, you guys, because we have got a bunch of product types to get through today. And similar to, I know, Stephen, he's got my vote too. Similar to what we heard with Chris, uh, Office isn't dead. It's not the end of its world, but it's definitely still having a little bit of its moment. So we're going to talk a little bit today about its stabilization, bifurcation, and the opportunity that you could see in the mess of what Office is. So Office is sitting right now nationally. We see a blend of anywhere from 16 to 20% being reported. We are still seeing the persistent negative absorption. We are seeing anywhere from 50, 60% of pre 2020 what we were seeing in the product type. The market has had a split. Class A is its whole separate thing, and we see commodity service as a separate. We'll talk about that in just a second. We do see flight to quality in office at an extremely high level all across the United States, especially for those larger, institutional type office spaces. If the landlord did not keep up with the amenitization and design of the space, they're going to have a problem, and it gets more expensive the longer you wait. We also see debt maturities, which are going to drive success. Biggest part inside debt to just really wrap your head around. We still have 17% of all commercial mortgages being held coming up for their bullet at the end sometime here in 2026. 17% is huge, by the way. That's billions and billions of dollars. So that's a really important piece. And office and multifamily were the sectors that held the largest quantity of those. And we are seeing some cap rate expansion and value reset still happening in this product type. Now, why is all of that important? I think we have to ground this all with actual data, because this is where clarity really matters. Right now, national office vacancy is sitting in that gap, which is a modern high. We've also seen multiple periods of negative net absorption, meaning that more space is being returned than leased. It's a pain point for our owners that are in this space. And even beyond that, we see utilization is still only about 50 to 60% of where it was in pre 2020. So, yeah, office is under pressure, but that's not the full story. Here's where I think most people get it wrong, right? It's this two entirely different asset classes at this point. And some might even bear to say it's a third of medical office being its own narrative altogether, which could be true, right? There's class A and trophy assets, and those are still leasing, still competing, still holding rents. Put an asterisk on that so long as they maintained their amenitization of the property. And then you see commodity space. And this is structurally a little bit impaired. We're seeing those B and C commodity spaces not being able to accomplish the same rental rates as we would see in Class A office. We're seeing their vacancy rates and their movement behave differently than Class A. And so because of that, we see the flight to quality. More tenants are saying, if we're going to take up office space, we'd rather take up less of it at a higher quality and better locations. They're upgrading space while reducing footprint. And top tier buildings understood that early on. And so they did what they needed to do to maintain their effective rents and to keep being competitive on the market. Whereas older buildings are not just vacant, they are becoming obsolete because some of the owners who are smaller owners, or they just had their mindset wrong about how to be competitive, didn't do what they needed to do to remain in the market as a really great quality asset to house their business in. And here's the real driver behind all of this, right? It's not just a leasing issue. It is a capital issue. A massive wave of loans from 2018 to 2021, those are all maturing right now. And they were underwritten under completely different circumstances and in a different environment than what Chris is underwriting deals in today. Today, refinancing often requires more equity, lower values, or lender intervention. So the real question in office today is not will it lease? It's is the leasing problem? Is the leasing the problem, or is capital the problem? After we get done with office, well, we get to pivot to our darling child that has done so well through COVID, and that's industrial. In industrial, I'll give you the high points and then we'll talk through them. We're seeing vacancy, uh, you know, 6 to 7%, up from 3 to 4%. We are seeing record supply of deliveries between 2023 and 2025. I'll tap on that in a minute, but that means during COVID, people were getting their act together to say, we got to build more of this because drop ship became such an important part of like the way we live life now. Rent growth slowed sharply in this first quarter because construction starts declined as well. And we see demand drivers just flat out intact. We'll talk about that in a moment, specifically things like e-commerce. And we saw this shift from a landlord favored market to a balanced market. That said, industrial is still one of the healthiest sectors, but it has clearly moved out of its frenzy phase, right? What we're seeing now is not a collapse, it's just normalization after an overheated run. We got really geeked out on it when everyone started wanting everything to their door like that, right? That logistics pipeline got really intense. And now supply chain and logistics are moving in different areas. So there's still a huge demand there. It's just not the same as it was before. What we're seeing now is not the collapse. It's just normalization. That's a good thing. Vacancy has moved up to about 6 or 7%, driven more than anything by a wave of new supply hitting the market. We delivered an enormous amount of space over the last 2 years. I believe it's the largest amount of space to hit the United States in the history. I don't know that as a fact, but looking at the numbers, it looks like it was the largest delivery of industrial space in the history of the United States. That's a big deal. And when we delivered that space, developers were responding to pandemic era demand. And at the same time, as all that hit the market, rent growth slowed. Why? Because there's more space available, from double-digit increases down to low single digits or flat in some markets. But the key insight is that we built ahead of demand. And now new construction starts are starting to drop, supply pressure is easing, and really important to understand, the demand drivers haven't gone anywhere. We still see e-commerce, we still see reshoring, we still see logistics, and we still see supply chain resilience. Industrial is not hemorrhaging. It's just normalized because we got really frothy. So this isn't a broken market. This is just recalibrating. And that changes how deals get done. We've moved from that landlord dominated environment to a more balanced negotiation environment, which means strategy, not momentum, is now what wins. So if you're an industrial broker, you're just throwing deals across to the finish line, you might have to get a little bit more involved with how you negotiate those deals and how you think about what gets them to close, right? Am I missing a page for retail? I am. Okay, well, in retail, we are seeing 4 to 5% in vacancy. Historic lows, by the way. We're just right on the cusp of it. With construction, we are seeing multi-decade lows, supply constrained by capital plus zoning issues. In most urban markets, there are zoning issues that are tethering what we could build in retail. The demand that we see the most of right now is for grocery, for service, and for necessity-based retail. It's leading to positive rent spreads and omnichannel retail evolution. We are going to a very service-based, right? And so this might be, I think, one of the most misunderstood sectors in the market right now. Because if you look at the data, right, it's sitting around 4 to 5%. By the way, for retail, I actually think that Deloitte had the best, like, they had their head wrapped around retail better than anybody else. And CoStar data is really great in this space as well. All of the ones I referenced before, CBRE, Cushman Wakefield, Deloitte, and NAR, they all had a great perspective on retail. I just felt like Deloitte really had that dialed in. And so while it's misunderstood, we have to look at the data to determine that, right? I don't want it to just be a gut instinct. Vacancy sitting around 4 to 5% nationally, near historic lows. And the reason is really simple. We stopped building retail, and construction is at multi-decade lows right now because of that. Developers really exited the retail space after 2008. I mean, you saw some of it, but they did not aggressively go after this product type. So what happens? Well, existing centers, especially well-located ones, are seeing strong demand with almost no new competition. And this is one of the cleanest supply demand setups in commercial real estate. And here's why the narrative shifted. E-commerce didn't kill retail. It forced it to evolve. If only office would have had that same force of evolution. Stores became fulfillment hubs, retailers became omnichannel, and weak concepts just died. And so what's left is a more efficient, more durable sector. That's why we see rents growing. It's why we see lease spreads be positive, and it's why we see strong centers that are winning. Once we get past this, well, let's look at multifamily. This was one of the ones that had some real struggle in the debt market because when interest rates were real compressed, lenders went juicy on office and multifamily at an institutional size. So vacancy nationally is floating between 6 and 7%. We are seeing record deliveries right now, and that amount of delivery still isn't solving our housing gap. Rent growth has been flat, and in some markets, we're even seeing it negative a little bit. Concessions are rising, construction starts are starting to decline, but demand is strong as ever because we have an affordability gap in what it looks like to buy a home. And debt stress is still there. This is the area where we do see a lot of willingness from the institutions that hold the debt to figure out a blend and extend, or to think about the terms for how to keep that debt on their books, but in a healthier way. And so multifamily is one of the most active and most understood sectors right now. This graph that I found, I would highly recommend you grab a shot of that. I think this very elegantly shows what that dip in the market feels like for multifamily. But here's the reality. We're at the peak of a supply cycle. So vacancy is around 6 to 7%. And we've just delivered the largest wave of new units in decades. That has pushed rent growth flat, and in some markets slightly negative. But here's the key distinction. This is not a demand problem. It's just a timing problem. Demand is still strong. Why? Because homeownership is too expensive for most people, because household formation still continues. And we still have long-term housing shortage in some markets to the tune of 30%. And importantly, new construction starts have dropped significantly because of the cost to build, because of zoning issues in most urban markets, which means today's oversupply becomes tomorrow's shortage. So what's happening in the meantime? Well, it means that concessions are rising, operators matter more, you got to be good at it if you want to stay in it, and capital is looking for better basis. That's not a broken sector. That's just a cycle playing out in real time. It's just a cycle playing out. We'll see it. I think it's a fun one to watch. Hospitality, because we have got some blooming and growing hospitality businesses in our world here at Launch. We look at hospitality, and what I think is interesting is we saw RevPAR recover. It's above where it was in 2019. Average daily rates are driving the performance that we're seeing here. Occupancy is slightly below pre-COVID, and leisure is strong. Leisure might be strong, but business is lagging a little bit because we just don't have the same like cash in pocket to be able to go travel as much, right? Supply is constrained, and we don't see a ton in the pipeline that's adding new deliverables in this space right now. Margins are pressured, specifically around labor and insurance, and transaction volume is rising. Why? Because some operators are getting burnt out. And because some of them are just moving into a different phase. You got to remember, a huge portion of the hospitality industry is owned by boomers. I don't remember the exact number, but it's somewhere above 50% is owned by boomers. And so we just see that moving things. But when I put all these metrics together, hospitality is one of the cleanest and clearest recovery stories in commercial real estate. It's also one of the most nuanced. This is not just a recovery story, it's really an operating performance narrative. RevPAR has recovered, ADR is driving growth, occupancy has improved, but unevenly. Here's what we kind of get lost in the sauce on. Revenue is strong, but margins under pressure. Why? Labor cost is up, insurance cost is up, and operations are more complex because guests expect more. And technology, as much as it can help us solve, technology requires different focus as well. So at the same time we're doing this, we watch new development be limited, and we don't see enough supply in that development pipeline. Ultimately, that's going to support existing assets. They aren't feeling it yet, but it's coming. And the performance is segmented. Properties that have, a really leisure, spa, experiential, they're strong right now. Business travel is still recovering. And this is a sector where we need to be examining more than ever the properties we're choosing to work with, the properties that we are deciding are what we're going to participate in. When you look at this as occupancy and average daily rate, that ADR is the thick blue chart and occupancy is the line. They've always moved and flow together. We have our flow misorganized right now. And a lot of that is economic conditions. A lot of that is just the way a household feels. We're not calling this a big R recession, but these numbers say we're in a big R recession, and that's impacting how we actually are feeling things. You'll notice this is going all the way back into 20 and 21. And so that's right where things started to feel the recession that came out of COVID. So after all of that, what is this market actually rewarding? What's actually starting to benefit? For office, it means capital plus use reset. You're going to need to look at those opportunities. For industrial, it is supply normalization. You got to make sure you're watching for that and not hoping that things will just magically show up differently. You're normalizing, get used to it. For retail, comply constraint might be your strength. What would happen if you thought about the limitation of supply as your strength? Multifamily, we're just at a cycle peak. It just misaligned. Sorry. So hold tight. It's coming. Hospitality, it's operational performance. And I added one more down here at the bottom, even though we didn't cover it as a core product type today. That's data centers. They're looking for infrastructure growth. If you understand how data centers work and the type of usage they have, and you're in a market where they're attracted to, you want to get after that because that's important. Lastly, what is the rewarding? We are rewarding quality. We're rewarding credibility in the market today. I think if you look forward in the rest of 2026, you're going to realize you want to behave like an underwriter. Like an operator who can underwrite really well, not just someone that's in your market, because that's going to get rewarded. You'll also see your ability to read debt and predict debt become extremely important. So we shouldn't price a property out just based on square footage. We should be talking to someone like Chris. What does this look like? It is rewarding landlords who tell the truth about asset competitiveness as well. And it's rewarding tenants who move with clarity instead of waiting forever. And it's rewarding brokers who understand the difference between a headline and a real signal. So be that agent who really understands that change in your market. This has been the launch state of the market at the end of Q1 of 2026. If you want more information like this, make sure to join us on the Launch Facebook page or the Nucleus Facebook page, and stay tuned for what Launch is bringing next. See you on the next one.